even though we are at an inflection point, all right, a very, very important inflection point. Do I have a trade? No. Shall I be taking a trade? No. Shall I anticipate a breakout? No. What should I do? Wait. You wait patiently for the markets to give you the clue what it wants to do. As simple as that. And as long as that is not coming, you should avoid thinking about a trade. See, monitoring market development, as I have said it repeatedly in the past, that it is my most favorite activity. I am fascinated by how the market develops, how the smart money traps the amateur traders, and this whole game unfolding is so fascinating. But that does not mean you are always looking for a trade. Even though you are in a zone where trade is likely to come, unless and until you have a clear signal from the intraday trading guidelines, it does not make a sense to try and look for a trade, because what happens is human mind has a confirmation bias, right? What does that mean? It will always try to find information that supports your point of view, right? Whatever your point of view is. If your point of view is bullish, it will help you find information that is bullish. If your point of view is bearish, it will help you find information that supports the bearish point of view. So if you are looking for something, your mind will try to find the evidence for that. So what happens is, in very early days when we were just living in the jungle, if you are walking in the jungle with a couple of your friends, and suddenly you see some movement behind some trees or bushes, you are not going to wait there to find out what that particular movement is all about, whether it's a predator, whether it's a prey that you can hunt. If you don't know something, you run the hell away and ask questions later. So what will happen? You run away and then you suddenly find out that okay, it's not a tiger or anything, it's just a deer, right? Which you could basically hunt and eat basically. So what will happen? You will just laugh about it, that oh, it just was a deer and we were afraid unnecessarily. But if it was a tiger and you stuck around to find out whether it's a tiger or a deer, and the tiger then hunts you instead, the outcome is so serious, you're going to lose your life. So our mind is also structured that way. A small fear, it will immediately jump to an extreme scenario and it will make you run away from that scenario, and that particular mechanism is still active in our mind. But our life is not in danger when we are trading, all right, unless and until you are leveraging extremely and borrowing money to trade. If you are just trading with a capital you can afford to lose, your life is not threatened. But the same logic applies. If the outcome of the trade is likely to be very negative if market goes lower and slightly positive if the market goes higher, even though the probability of going higher is high, you choose the short trade. And if your system, because, and why the intraday trading guidelines are here, they are here to prevent you from getting on the wrong side of the market. I have always maintained intraday trading guidelines are not entry exit rules or set of instructions you have to follow to get into a long or a short trade. No, they are there to prevent you from getting caught on the wrong side of the market, and that is the job that they do fantastically well. Although there is a chance that market might go sharply lower, but we don't have a signal, we avoid the trade, right? Now I would even say, like, let's say the market goes lower and pulls the VWAP down, and if you get a pullback you sell, unless and until it moves away from this reference nicely. So even after you took this short trade, all right, this is VWAP and you took a short trade here, and the market goes a little lower, hits your intraday target and recovers back up towards this reference, I would not be too keen to carry that trade forward. What I want is for the market to move sharply away from this reference without any pullback or any reason for a pullback. And why I want that is because whenever you are at an inflection point, right, there are both sides active here. Status quo time frame trying to defend by buying, right? Then there are discovery time frame that are trying to break this and take the markets away. Now, if the market goes a little lower and recovers back up, who is winning here? Is the discovery time frame winning or status quo time frame winning? On the short term, it is the status quo time frame. And if we go and we close right at this reference, it is a win for status quo time frame, not the discovery time frame. But let's say market takes resistance here, comes back and then closes far away from this reference, then it clearly tells me that status quo time frame have completely given up. They are not interested in bringing the price back. Where do you think the price is going then? Then the price is going much lower. All right. So let's say this is the range that status quo time frame are trying to defend. Right now they're doing a good job. But let's say by the time market closes here, far away from this reference. What does that tell me? Now the status quo time frame have given up on this range. Discovery time frame have total control, and now they are not going to take out this reference, this reference. They probably will go and hit this low. They probably will go and hit this low, this small consolidation. They might try to find out what lies beneath that. So what is happening here is that there is a possibility of a big fall and there is a possibility